RP Future Millionaire. It's Thursday, August 10th, 2023 at 9:31 a.m. Eastern Standard Time. And this is some breaking news coming in for the July CPI reports. And it came in pretty bad, but the narrative they're going with right now is pretty interesting. They're talking about how the inflation came in less than expected. But what we'll go over is the food and energy. A lot of things went up as expected, rent. But they are starting to spin this as it came in less than expected. And this is the national narrative right now. So I'm sharing you the CNBC report. You'll get to listen to this after I read it. But we'll form our own opinion here at the end of this. July CPI report shows inflation gauge rose 3.2%, less than expected. So this came out 16 minutes ago. The consumer price index rose 3.2% from a year ago in July, a sign that inflation has lost at least some of its grip on the U.S. economy. Prices accelerated 0.2% for the month in line with the Dow Jones estimate, the Bureau of Labor Statistics reported Thursday. However, the annual rate was slightly below the 3.3% forecast though higher than July. So there's the chart. Excluding volatile food and energy prices, so-called core CPI also increased 0.2% for the month, matching the estimate and equating to a 12-month rate of 4.7%, the lowest since October 2021. The annual rate for core also was slightly below a Dow Jones consensus estimate for 4.8%. Markets reacted positively to the report, with futures tied to the Dow Jones Industrial Average up nearly 200 points and Treasury yields mostly lower. Almost all of the monthly inflation increase came from shelter costs, which rose 0.4% and were up 7.7% from a year ago. The BLS said more than 90% of the increase came from that category, which accounts for about 1/3 of the CPI weighing. Food prices increased 0.2% on the month, and BLS said energy increased just 0.1%, even though crude prices surged during the month and prices at the pump jumped as well. Used vehicle prices declined 1.3% and medical care services were off by 0.4%. The comparatively tame inflation levels helped raise worker pay. Real wages increased 0.3% on the month and were up 1.1% from a year ago. Mind you, inflation's up 3.2%. Is that what they came in today? What was it exactly? 3.2%. So real wages are up 1.1%, but inflation's up 3.2%. So you're actually down. If you actually are paying attention to what this means, your paycheck is going and you're getting 2.1% less on your hourly pay, even though it says you're up 1.1% on the year. You're actually making just over 2% less per hour, even though it's more than that if you look at the true inflation rate. The annual rate for headline inflation, while below expectations, actually marked an increase from the 3% level in June. Together, the latest batch of data shows that while inflation has come well off its 40-year highs of mid-2022, it is still considerably above the 2% level where the Federal Reserve would like to see it, and high enough that cuts in interest rates are unlikely anytime soon. While inflation is moving in the right direction, the still elevated levels suggest that the Fed is some distance from cutting rates, said Seema Shah, chief global strategist at Principal Asset Management. Indeed, disinflation is unlikely to be smooth and will require some additional economic pain for the 2% target come sustainably into view. Deceleration levels, though, are at least taking some of the pressure off the Fed to keep tightening policy. Actually, I'm not going to play the video. I'm just going to read it. With how bad my internet connection is, I'm just going to read this whole thing. After hiking benchmark interest rates 11 times since March 2022, central bank officials are widely expected to take a break in September. However, I will be home later, so I will be back to normal operating standard and procedure. So I hope to see everybody on the live later today. As we're doing Winning Wednesdays today during our live tonight, we're by $75 a week in algo since the internet cut out on us last night, or me. However, it's up for debate what happens from there. And public statements from policymakers have shown disparate opinions. Earlier this week, regional Fed President John Williams of New York and Patrick Harker of Philadelphia made comments indicating they could see the rate hikes at an end. However, Governor Michelle Bowman said she expects more increases, while fellow Governor Christopher Waller also has pointed toward the possible need for additional hikes ahead. Regardless of whether the Fed approves any additional rate hikes, Virtually all members have agreed that the higher rates are likely to stay in place for some time. The higher rates have yet to put a dent in economic growth. The first half of 2023 has seen GDP post gains of 2%, 2.4% in the first quarters, respectively, and the Atlanta Fed is tracking third quarter growth of 4.1%. Payroll gains have been slowing but are still solid, and unemployment is near its lowest levels, or lowest since late in 1969. Consumers have begun to be a bit stretched and increasingly are turning to credit card and savings for their spending. Total credit card debt surpassed $1 trillion for the first time this year, according to New York Fed data. However, more economists are beginning to expect the U.S. can avoid a recession despite the aggressive rate hikes. Bank of America, Goldman Sachs, and JP Morgan Chase all recently have forecasted a contraction is becoming less likely. You would expect that out of them. What are they going to say? But recession is already here. The only question is how soon do we reach hyperinflation? If you appreciate this content, make sure you hit the like button. And if you appreciate this news and me bringing it to you, hit the like button. But if you appreciate my content overall, please hit that subscribe button.